Hello, my friends. Today is December 18th, and this is my December FOMC debrief. So, we just had the last FOMC meeting of this year. And before we get into what happened, let's take a step back and level set. So, today was a meeting where we had a dot plot where the Fed kind of gives you a sense of how they're thinking about the world. The last time we had a dot plot was in September. And at that time, the Fed was having a bit of a panic. So, in the September dot plot, they were basically suggesting that GDP is going to slow a lot, 2%, unemployment rate is going to jump to 4.4%, and inflation is going to come down. Basically, they were in a panic that we would have a recession. And so they were forecasting that we would have, another cut today in December. Now, between then and now, economic data has consistently surprised to the upside. We've had the unemployment rate 4.2% below what they were expecting, GDP growth close to 3%, and inflation a little bit hotter than they expected. Now, even after all of this positive data, the Fed still decided to cut. So a lot of people were kind of scratching their heads. Again, why are they cutting today? Now, to be clear, the Fed never surprises the markets or tries not to. And so the market fully priced in today's cut already. It was a little bit unsure a couple weeks ago, but after Governor Waller came out and gave his nod to rate cut and data continued to cooperate, the market was pretty sure we'd get a cut today. And so today's meeting was unequivocally hawkish. Now, I was surprised. I was thinking we would have a dovish meeting, but no, it was unequivocally hawkish. Now, the hawkishness comes largely through the Fed's dot plot. Now, the market, again, last time they were penciling 4 cuts for next year. Heading into the meeting today, the market pricing was suggesting 2 cuts next year, and the economists surveyed were suggesting 3 cuts on the dot plot. But the dot plot today surprised the survey, and it actually met the market at suggesting just 2 cuts for next year. So again, that is a hawkish surprise. Now, the rationale behind this more hawkish dot plot was that the Fed all around upgraded their economic forecasts. They were thinking that growth is going to be better, unemployment was going to be better, and basically everything is going to be better next year than they had expected. And so because of that, they're thinking that they don't need to cut rates as much. So many people are asking, okay, well, if everything is fine, why are you cutting rates at all? And I think digging deep into the conference, I think the answer to that is that in his heart of hearts, Chair Powell thinks that inflation is over, so he's not really concerned about it, and he is more concerned about the rise in unemployment. Now, we kind of had a taste of how Chair Powell thinks about inflation at his November conference, where he was basically, pointing to 3-month annualized inflation is coming down, 6-month annualized is coming down. A lot of inflation as just, lagging shelter, which we all know is eventually going to come down. He's very, very upbeat about inflation. Now, between November and now, we did have an inflation print that was higher than expected. So it seems like he had to kind of reconcile that a little bit. But when push came to shove, this is what he said.
I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. You do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents, start to equilibrate better with, new leases that turn over. Not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. I mean, a good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down is still intact.
Basically, he's saying that, if we divide inflation into different components, looking at goods, they're about where they were before the pandemic. Now, looking at services, yeah, they're a little bit hot. But then, you got to break out housing, which we know is lagging and it's coming down. And looking at non-housing services, we can further break that down into services that we have transactional prices, so market-based, and services that are imputed, which are basically done through a mathematical formula or survey. So he says, looking at these services that are marketable, let's say the price of meat, price of eggs, and stuff like that, they're already, on time towards 2%, everything's okay. The reason that services is high is because of this non-marketable imputed stuff. For example, imputed stuff would be stuff that is not actually transactional. A very famous part of imputed stuff in PCE is owner's equivalent rent, where people are surveyed, where do you think your home would rent if you were to rent it? Basically trying to gauge how homeowners are experiencing shelter inflation. Again, that's not market-based. It's just a survey. It's an imputed measure. And that stuff seems to be keeping inflation high. Now, what I take away from this is that Chair Powell is kind of twisting himself into circles to kind of explain to everyone why that inflation, although the index continues to show, above 2%, but when you look one level beneath, looking at the components, it's really just stuff that's either lagging or just stuff that's not really an accurate measure of inflation. So again, to me, my takeaway is that was really dovish. Again, he is not worried about inflation. Although, to be clear, when you are Fed chair, you are the boss, but you still have to manage a whole other people whose opinion matters to varying degrees. Today's FOMC meeting, we did get one dissent by a Fed president, and this person was not even mentioned in the Q&A. She's not particularly important, but she is a very smart person. But I think it's just useful to know that, again, even after this hawkish dot plot, he was not able to get across the board consensus. So some degree of a little bit of an internal political disagreement over there. Maybe she wasn't the only one. So in any case, the outcome was a more hawkish dot plot. Now, the other takeaway from this is how Chair Powell was thinking about unemployment. So we all know that the unemployment rate has been gradually rising over the past couple years. Now, his view on this is, somewhat upbeat, not totally. Now, you could have a rise in the unemployment rate through, more firings, right? That's what we don't want to see. But he's saying that the rise in unemployment rate, not so much increased firing, it's just the hiring rate is really low. And so as our population grows, as new people graduate from the schools and enter the workforce, or as laid off people try to find new jobs, that hiring rate is really low. And that's the reason why the unemployment rate will continue, has been rising, and from his view, will continue to tick up a bit every couple of months. So all in all, the market, again, took a look at the dot plot. Again, rates screamed higher. You got the across the curve, rates screamed higher, and that strengthened the dollar significantly. That kind of took down a lot of, you would say, instruments that are related to the dollar, like gold. And of course, the equity market totally tanked. So the market is kind of seems the market was in a bit of a shock today by this. But looking into the conference qualitatively, I didn't find it to be particularly hawkish. And I still think that we are probably at peak hawkishness for the Fed. But I guess we'll find out in the coming months. All right, so that's all I prepared. Today, I also did an interview with Felix of Forward Guidance, and that'll be out shortly as well. All right, talk to you all this weekend on Saturday. All right, bye.